Good afternoon, everyone. My name is Alana Brown. That is Eric Restrepo, and we are here from solo401k.com and Nabers Group. Today is the third part of our webinar Wednesday series where we're concentrating on contributions. Today, we are talking about voluntary after-tax. I know a lot of you guys are excited. I hope you have lots of questions. While we're going through the slideshow, go ahead and post them down there somewhere. I'm happy to take all of your questions. Just so you know, next week we'll be doing the mega backdoor Roth. So this week we're focusing on voluntary after-tax contributions. Next week will be the mega backdoor Roth. If you guys can let us know, can you hear us? Can you see us? Let us know in the chat box, which is, I think it's over there.
That way? It's over that way for me.
Scared to point, but pointing is rude. Okay, perfect. Thank you, Glenn. Hello. Is this only for Roth? And Gary asks, is this only for Roth participants? If you have a solo 401k, you have a Roth component in there, just so you know. Come back with a question clarifying a little more, Gary, as we go through this. And don't forget, guys, post it down there. All right. We are going to jump in here in a second. Oh, and today, by the way, is October 13th, and it is Wednesday. So let's jump in.
And Dave's asking, how do we access the first two presentations? Yeah, it's kind of tricky when we do these series. We should probably go over that, Alana, because you have to go into the event on Crowdcast, and then you go to the very top. It's like a drop down. You can go back and look at the old events in there. So it's not going to be. I saw a person post a question about that in the network too. But when we do series, it's in the actual Crowdcast event. They have to go into the event, and then there's a little drop down. They pick, past dates basically in there. So that's how you do that.
Yeah.
So anyways, we're going to go into solo 401k after tax contributions. Yeah, we did already cover the employee salary deferral, and we also covered the employer profit sharing contribution. So if you guys haven't watched those webinars, definitely go back after this. Watch this one, obviously, but then you can go back and watch those other ones. Those are really good. Quick little disclaimer. Obviously, this is not financial advice. This is not tax advice. This is not legal advice. We are just doing education here today. So we love doing these educational webinars for you guys so you guys can get the maximum out of your solo 401k, get all the maximum advantages there. But just keep in mind, if you do have legal questions, tax questions, just ask your counsel. So a little bit about us. We launched the IRA LLC back in 2003 and the solo 401k back in 2006. We have had consistent IRS plan document approval for 15 years. The cool part about us is actually we all have our own checkbook control plans, right? So all of the team members here, are familiar with how they work, not just from like a theoretical standpoint, but actually from actual practical use. We also work with the IRS and the Department of Labor to make sure that your guys' documents are fully compliant, up to date. You don't have to worry about any of that regulatory stuff that's constantly changing. We also never handle your money, so we're not a custodian. So we're just a plan document provider, and you guys get to pick where you want to have your funds located. We do specialize in checkbook control, right? So it's not a custodial plan where you have to ask, every time you want to make a transaction. You basically have full checkbook control, so you can send your investments, to wherever you want to, right? Gold and silver. We're not going to get into all the different ways you can invest, but there's all kinds of different ways to invest: real estate, precious metals, cryptocurrency, all kinds of different choices. So just talking about contributions, basically, if you have a small business, right, You can contribute some of that money that you're making in your small business or your self-employment activity. You can contribute that either pre-tax. You can also contribute that after tax. Since you're both the business owner and the employer, you get to take advantage of the two different types of contributions. So, and without getting, super complicated, we did go into depth on each of these on the last two webinars, but you basically have two types of contributions. You have employee salary deferrals. That can be up to 100% of your compensation, up to $19,500. That can be either pre-tax or Roth, or a combination of the two. Then you also have your employer profit sharing contribution. That can be between 20 to 25% of your net profits. That does depend on your business structure, right? So if you're an S corporation, if you're incorporated, it's that 25%. If you're a sole proprietor or single member LLC, it'd be that 20%. And that's always pre-tax. Maximum contributions are $58,000 for the solo 401k in 2021. If you're 50 or older, that's all the way up to $64,500 because you do get that extra catch up. Contributions are based on your net compensation. If you're incorporated, it's based on your W-2. The more you earn, really, the more that you can contribute. So, but we're also going to talk about a third type of contribution today.
All right. Enter the voluntary after-tax contribution. So what are voluntary after-tax contributions? So it's a voluntary employee contribution. So the contributions, they can be withdrawn penalty-free at any time. Contributions are not taxable. The growth is taxable. If you make a voluntary after-tax contribution and invest as is, the growth is going to be taxed. So if you contribute $10,000, it grows to $15,000. $5,000 in growth is taxable upon distributions, just like your pre-tax contributions. So many participants will choose to convert these after-tax funds to Roth because these contributions, they do not start out as Roth. So this is always important, and it may sound confusing, but just listen closely. While all Roth contributions are after tax, not all after-tax contributions are Roth. So not all plans allow for these types of contributions, but luckily, if you are a Nabers Group client, your solo 401k allows for not only the voluntary after-tax contribution, but as well as in-plan conversions. These are really important components to the mega backdoor Roth, and to doing any kind of in-plan conversions, you need these parts in your plan. So our plan is definitely the most flexible plan out there. It allows for all of these items. Like I said earlier, while we were introducing ourselves, we'll be covering that mega backdoor strategy next week. So if you have any questions on that strategy, just join us next Wednesday, same place, same time. Today, we are going to focus on the voluntary after-tax contributions. So typically, Roth contributions are limited to that $19,500. Of course, if you're over 50, you get your catch up. So you can do up to $26,000 in Roth contributions. With the voluntary after-tax contribution, you can actually contribute up to 100% of your net compensation. So the maximum voluntary after-tax contribution is $58,000. And if you have that catch up, it jumps up to $64,500. So this is per participant. So if your spouse is on the plan, you can each get up to $58,000 into the voluntary after-tax contribution bucket. Of course, you cannot exceed your maximum contribution on the plan when selecting, what contributions you're going to make. So you'll decide how to split up that $58,000 contribution limit. So let's take a look at an example. Lisa, she's 44 and has an S Corp. She pays herself $100,000 in W-2 wages. Lisa decides to contribute $10,000 to her employer contributions. She wants the rest of her funds to grow tax-free. She's going to want them classified as Roth. So Lisa can contribute $48,000 as voluntary after-tax contributions. How did we get that number? The $58,000 minus the $10,000 she made in employer contributions. Now left over, she's got $48,000 remaining for the voluntary after-tax contribution. Voluntary after-tax contributions can be converted in plan to Roth. That's what most people do. This allows Lisa to get more funds into her Roth 401k bucket than she would have been able to do. You know, if she did not utilize this strategy, she would be limited to that $19,500 for her Roth funds. So once Lisa completes her in-plan Roth conversion of voluntary after-tax funds, she ends up with $48,000 in Roth funds for that taxable year. So for that tax year. So pretty incredible. More than double than she could have originally done for Roth funds.
So let's, yeah, that's great. I love that. Let's go over best practices and logistics. So, you know, basically, how does it all work, right? You basically need 3 different accounts. Essentially, they're sub-accounts, right? So your solo 401k is the umbrella, but you can have multiple sub-accounts underneath. So you may have the traditional or the pre-tax account. You may have a voluntary after-tax account. And then you might also have a Roth account, right? Just depending on how you want to utilize it. It's kind of a choose your own adventure plan, right? So you could, if you don't care about the voluntary after-tax, just have the pre-tax account. But if you're looking to execute the mega backdoor strategy, which we're going to go over in detail next week, you're going to want to have most likely all 3 of these different sub-accounts. You know, you are your own administrator, you're the trustee, you're the record keeper. So it's really your job to keep detailed and accurate records. So you just want to keep these accounts separate. That way you can, you know, for your own purposes, designate this is traditional funds, this is, you know, after tax, this is Roth. And then having those distinct, you know, bank accounts, those structures for each tax classification, it just makes your record keeping so much more simple. So let's go back to Lisa's example. Lisa contributes that $10,000 for her employer contribution, which is always pre-tax. It's that traditional bucket. She wants the rest of her funds to be Roth. Lisa can contribute that $48,000 as a voluntary after-tax contribution. So that's the $58,000 minus the 10. That's the 48. So she doesn't do that directly into the Roth though, remember? So she wants to put that, you can see visually here, the 10,000 can go into the pre-tax bucket. The 48,000 has to go into the voluntary after-tax bucket. And then she typically on that, and this is, we're getting a little bit into the mega backdoor, but you want to wait a day or two. Don't do it immediately, but you want to, then she can do that in-plan Roth conversion. There won't be any taxes due on that conversion because it's already contributed after tax. And then that's how she accomplishes getting that over to the Roth 401k bucket. So Lisa needs to do an in-plan conversion. That's what I was just saying. Yeah, that basically reclassifies. So Roth, just the big thing, Roth is a designation, right? Like Alana said, you know, there's not all after-tax contributions are Roth. So we want Roth because if we do it correctly down the road, we won't have any taxes to pay on the original principal or the growth. So Lisa did convert her funds to Roth, so she would not want to pay taxes on any of that growth. So after-tax contributions are tax-free, but any growth on those contributions, so if she left them in that voluntary after-tax bucket, she would have to pay taxes on all the gains in her investments. So after the voluntary after-tax contributions are made, you can choose to convert them to Roth funds or not, right? You're going to use the Nabers Group in-plan conversion document found in your dashboard. You'll also need to complete a 1099-R to document that conversion. This would not be a taxable event, like I mentioned. So because there's been no growth on the contributions, it was probably just cash, right? Once you've documented that conversion in your plan records, just send the funds over from the voluntary after-tax bank account to your Roth bank account. So it could be, you could send it over to another platform, but you could maybe just be executing this all within the same either bank account or brokerage account. And this is a look at that in-plan conversion form. So you'll find that in your dashboard. You're going to want to write in voluntary contributions on the form under Part 2. That way, you know for your own records that that's not going to be a taxable event. Also, you'll want to file Form 1099-R. 1099-R, it's not allowed to be filed as a PDF. Only approved filers can file and submit the 1099-R. You just want to check with your tax professional. Maybe they're an approved filer. Otherwise, we provide an entire list of resources who can support you with quick online filing. It's pretty straightforward and simple. Also, check out our knowledge base for helpful resources. If you go to support.solo401k.com and type in 1099-R, it's going to pull up a detailed article going over exactly what you need to do. It actually has links to preferred providers that do the 1099-R. So if you guys have any doubts about that, just go there and use that article. It goes step by step through the process. So since you're the plan administrator, you do want to furnish a copy of that 1099 to yourself by January 31st. The IRS should receive a physical copy by February 28th or an e-file of the form by April 1st. Your tax professional or online filing service will help you accomplish that by that deadline. So you don't owe taxes if you're converting from after-tax to the Roth, but you do owe taxes if your after-tax contributions have grown, right? You will owe taxes on the growth. Voluntary after-tax contributions are not reported on your personal tax return, your 1040. After-tax contributions are also not reported on the W-2. Some employers list the after-tax contribution amount in box 14 of the W-2 for it's kind of informal purposes. However, this is really truly optional. So it's kind of up to you guys if you want to include that there. It's not going to be deductible, right?
Awesome. Thank you, Eric. So a little recap. While all Roth contributions are after tax, not all after-tax contributions are Roth. The voluntary after-tax contributions allows you to increase your Roth funds drastically. You can contribute up to $58,000 in the voluntary after-tax contributions. Funds need to be converted to Roth in order to reap the benefits of that tax-free distribution. And like we've said numerous times, stay tuned next Wednesday. We will be covering the mega backdoor Roth conversion strategy. Like always, we like to remind you guys of the 3 ways to get support from us. You guys have lifetime access to ongoing support and, of course, these trainings. If you haven't been to our network, you are missing out. So make sure you check out our network at solo401k.net. Our website, which is like an encyclopedia about the solo 401k. So check out solo401k.com. And then, of course, our knowledge base, which we pulled some articles for you during this presentation. That is support.solo401k.com. Here is our contact information. If you are not a client of ours yet and you'd like to chat with Eric or I, go to solo401k.com/consult. You'll get a full 30 minutes to go over, your own individual situation and will help guide you through the whole process. Any of our clients out there that need help, you could always email us at info@nabers.com. And you could always give us a call. Let's jump in to some questions. So the first question comes from Hector. After-tax contributions, how to fund them or how to account for them? For example, does the business fund them or do I?
Yeah, so that's going to depend on your business structure, Hector. So, it's an employee contribution. So it's like we went over, it's a voluntary employee contribution. So technically it's after taxes, right? So it's after you've paid self-employment taxes, after you've paid federal and state potentially. Where the funds actually come from, it really depends on how your business is set up. Like some people that are operating as a sole proprietorship, they just have one bank account for their business and for their personal, right? So the key piece is just that you have to have enough money to contribute back in after paying the taxes on it, right? So if you don't have 58,000 after taxes, then you can't put in 58,000. It has to be income that's earned in that sponsoring business, and it has to be enough after taxes to be able to be put in. As long as that's the case, justifying where the funds come from, it's probably just work with your CPA on that, because if your business structure is a S corp, maybe they'll have some advisement where the best place to have that money come from. Anything to add on that one, Alana? Or
no, I think that was great. Thank you, Eric, and thank you, Hector, for that question.
Good question. Hector also had another question here. I have 2 bucket accounts, the Roth and the traditional solo K buckets. When I'm investing in crypto with an exchange, how can I distinguish between the two, or with any investment? Percentage base?
Yeah, great question, Hector. Best practices for that is you'll probably want 2 separate exchanges. So that's really important when you're doing crypto. You don't want to have to keep track. It's going to get too complicated. So 2 exchanges for the crypto. As for other investments, because you could invest also your traditional and Roth funds together, maybe like in a real estate deal. So just make sure that you have the percentages correct. So you're right there, Hector. So the same percentages out need to be the same in. So it's like if it's 20% of Roth funds and you're getting like rent checks in every month, 20% of those rent checks need to go into the Roth bucket. So just keeping really good documentation is important. And, keeping the different tax classifications in separate bank accounts, crypto exchanges, brokerages. So great question as well.
And also just Hector, we just launched crypto trading to activate crypto trading with your 401k. I don't know what platform you're doing that on now, but we actually can open that account for you on Gemini. And with us, I know we can have you have 2 separate accounts on Gemini, one for your traditional and one for your Roth. So you just want to designate, I'll shoot you this application this is for clients that already have, either a solo 401k or a checkbook IRA with us. If they want to activate crypto trading in their account, just go here. But if you wanted to set that up, Hector, you would want to choose, you would want to just put down, if you want a Roth version, you just put your trust name followed by like a little hyphen and then Roth. If you want it just traditional, just leave it as is. So that's just a little caveat for how we're doing that.
Great. Yeah. And thanks for bringing that up, Eric. Yeah. For everyone out there, it's really, a big struggle a lot of our clients have is getting these crypto exchanges open. So you know what? We now have the solution. We're going to do all the heavy lifting for you. We will get your account open in, I think it's like 3 to 5 days. So really, really easy. And we have the fees are very minimal. You even for the first, is it Eric, the first 30 or 60 days?
60 days. Yeah.
60 days, we're waiving 1%. So Everyone should check out the site that Eric just posted. This is very exciting, and we just started it. Okay, on to the next question from Glenn. About the proposed bill to change the contributions. Would the proposed bill prohibit the after-tax contribution? Assume income is under $400,000. I realize it's just a bill, but still trying to understand this after multiple questions on the Nabers Solo 401k chat. Thanks, I appreciate it. Okay.
Yeah. So Glenn, yeah, my understanding is that the proposed bill, just keep in mind, this is not a law. So we do only follow laws. We don't follow bills. But the proposed bill includes language around closing the back door. And that would be for all income levels, as far as the way that I read it. I'll shoot you the article that I wrote in the network. We'll shoot that to you in the chat there, so you could take a look at that. But yeah, that actually has a link to the actual, bill, not the bill itself, but it's the summary. So it kind of goes over that in detail.
Yep. And I know everyone's very concerned about this bill. Like we keep saying, it is just a bill right now. So we're hoping it's not going to get proposed or passed. And if it does, it might be very watered down. And, there most likely will be some kind of grandfather clause as well. So, start making some moves, roll all of your funds into your self-directed account and get control of those funds. And also, we will be keeping you guys posted. Anytime we get any information about the bill, like we always do, we will send out emails and let you know how things have changed. But for right now, nothing has changed. So good question, Glenn.
Sorry, just looking for that bill. Maybe you want to read the next one while I'm looking for that.
Mm-hmm. Okay, so the next question comes from Gary. So then is it fair to say that I do have a Roth that started with my solo 401k, even if I have not contributed? Great question, Gary. Yes. Anyone that has a solo 401k with us, you have your Roth component. So all of our plans come with the traditional component, the Roth, voluntary after-tax. So yep, Gary, you are ready to roll. So what you want to do now is, if you have a trust checking account, just call the bank up, have them add a sub account, nickname it Roth, and now you're using your Roth bucket. If you want to utilize the voluntary after-tax bucket, you may want to add an additional 2 accounts. So one for Roth and one for voluntary. So hopefully this presentation has been helpful to you, Gary, to get you started. And just let us know if you have any additional questions. I do know that we have a Roth 401k presentation that we did. It's in our network. I'll try to grab it if I can multitask while reading and answering questions. Okay, the next question we got here from Glenn. Assume I make less than $400,000 married, filing separate. Can I contribute after tax to my solo 401k an amount over $26,500, but under the max catch-up limit? I think it's $64,500. This is a $38,000 difference. Just want to make sure I can still contribute the $38,000 after tax if my income remains under the $400,000 limit. Once in my solo 401k, can this be converted to a Roth 401k under the proposed legislation, or does it have to remain in the solo non-Roth? So I think that's
Yes.
the legislation.
Yeah, so like right now, for 2021, none of that applies, right? Even if the bill passes through, Glenn, you're okay for 2021 to do any and all of this after-tax contributing, right? As far as like, again, it's a bill currently at the moment. It's not a law, but you read that article, it goes over it in detail. But basically, the after-tax closing the back door, at least what they're proposing, I don't think it applies based on income level. Yeah, so it just take a look at that language in there, but I think that they're looking to close the back door for all income levels, if that helps. So basically, voluntary after-tax contributions would potentially go away. So get those done this year, for sure. But again, it's not a law yet. So until it becomes a law, we're not going to worry at this point.
Not going to worry too much. And if you're feeling a little worried, we are recommending talk to your state officials. Let them know. We all did that here at Nabers. Voice your opinion.
Question from Brian. He says, can I make an after-tax contribution before I get my paycheck, assuming I know how much I will be paid?
Yeah, if you're comfortable with that, that should be okay. Of course, double check with your CPA. And you do want to be careful because over contributing is a big deal. You probably have to distribute your funds and pay the penalties. So just be careful, Brian. Always double check things with your CPA. The next question comes from Mike. Is the voluntary after-tax contribution a component of the mega Roth?
Yeah, it is. Yep, 100%. That's you can't do the mega backdoor without voluntary after-tax contribution. So the idea of why it makes it the backdoor, the front door is a direct Roth contribution, right? That's going through the front door. And just to be clear, guys, that's not going away by any of this proposed legislation. So you can still make Roth contributions directly with the solo 401k. And that's not based on income or anything like that. You can make that even as high as your income is. That's always going to be there. Another question from, I can't see who that's from. Is there a name on there that you see?
Yeah, Todd.
Todd, okay. From Todd, if I plan to make $58,000 contributions to voluntary after-tax, can these be rolled over to a Roth IRA instead of a Roth 401k account? If so, any benefits of doing so?
Yeah, great question, Todd. So you can go from your voluntary after-tax contribution out to a Roth IRA if you want. So the big deal here is, you may want to keep it as Roth 401k because with the solo 401k, you can invest in alternative investments. If you're moving it out to a Roth IRA that's at a brokerage that's not self-directed, now it's stuck there. So something to really remember is once Roth IRA funds are Roth IRA funds, they are never going to be anything else. The Roth 401k can roll into a Roth IRA, but a Roth IRA cannot roll back into the Roth 401k. So definitely something to strategize. What a lot of people do is they roll out to the Roth IRA when it's close to retirement age because there's no RMDs, no required minimum distributions in a Roth IRA, where there is in the Roth 401k. So it's up to you, just wanted to give you the details there, but that is why people would roll out to the Roth IRA because no RMDs. But also remember, if you're moving it out of your solo 401k, you're losing, access to funds to invest in alternative investments. And I do see here, okay, should the entire $58,000 be an after-tax or some after-tax and some Roth 401k contributions? So I think you're saying, can you make some directly to the Roth and the rest to the voluntary? Absolutely. You just want to make sure that you're not going over that 58. That's what's most important. Is if you're under 50 years old and your limit is 58,000 for your entire plan, you're not contributing more than 58,000. So excellent question, Todd. The next question comes from Tracy. How often do you need to fill out the in-plan conversion form? Every time you make the transfer to the Roth or doing one form at the end of the year? Okay.
Yeah, great question. You're the plan administrator. So, you know, that's a good question. I think you could probably do it at the end of the year if you wanted to, right? Tabulate all of the different moves that you made. The risk is like maybe you forget about one, right? But you just want to make sure you're keeping detailed records. So whatever helps you do that, if you want to have each one done for each conversion, then do that. But yeah, that's kind of just more of a best practices question, I believe.
It is. Yeah. And a good one as well.
Yeah, it's definitely a good question. Yeah. Got a question from FB. Is there an after-tax contributions calculator on the website?
So yeah, great question. So we have the contribution calculator on the website. But what's important to know about the voluntary after-tax contributions is that it's 100% of your net earned income. So if you're W-2 wages, because you're an S corp or a C corp, if you're making at least $58,000 in W-2 wages, you can contribute that whole amount. Same if you're a sole proprietor, LLC, if your net earned income is at least $58,000, you can do that full amount. And then what's most important, FB, like I said before, is you're not over contributing. Even though you're allowed to put $58,000 into that voluntary after-tax bucket, if you're putting $10,000 into the pre-tax, you can't put $58,000 into the voluntary. You can do 48,000. So great question, FB. So Bal has a question. Is after-tax contributions is based on W-2?
Yeah, so that again depends on your business structure. Also, like if you're incorporated, then yeah, all your contributions are based on your W-2. So whether it's pre-tax salary deferral, or a Roth salary deferral, or a profit sharing contribution, all of those are based on your W-2 if you're incorporated. If you're not incorporated, so you're a sole proprietor or you're a single member LLC, then yeah, it's based on your net earnings, right? So, but yeah, that is a great question. Key piece with the voluntary after tax, if incorporated, it is based on your W-2. So you will have to pay those self-employment taxes and have to have enough money after paying tax on, federal, state, self-employment tax to be able to then contribute that after taxes back into the plan.
Perfect. Great question. Great answer.
Got a question from Eric. He says, the 25% tax deductible contribution, is it 25% of W-2 salary or business income left after salary was paid?
So you're talking about your employer contributions, like Eric was talking about, if you're incorporated, contributions are based on your W-2 earnings. So it would be 25% of your W-2 earnings. Eric, anything else to add to that?
Yeah, just it's your gross. So like some people kind of get confused about like, if I do the salary deferral, do I subtract that from, my W-2 and then do the 25%? No, it's based on your gross W-2. So, but yeah, we did a whole webinar on that, Eric, on profit sharing contributions. So go back and check that out. It's if you go in this event after we finish, there'll be like a drop down menu. You can just go select that I think it was last week, right? We did the profit sharing. So just select last week, and then you'll be able to view that webinar as well.
Perfect. So then Steve says, use Lisa as an example. She does the full contribution salary deferral pre-tax in her thrift savings plan with the federal government, and her S Corp business pays her $70,000. How much can she contribute in after-tax voluntary in the solo 401k if she's over 50? I love this question, Steve.
I love this. Yeah. I love these examples. It's fun.
Perfect.
Yeah, no. Yeah, so voluntary after tax actually is not limited by her other contributions, right? So employee salary deferrals are. So like that's limited by all of her plans, right? So she can't do any more employee salary deferrals once she's maxed out. Like for her, if she's over 50, she has the 19,500 plus she also has the 6,500 catch up. So a total of 26,000. So let's say she maxed that out. She can still do up to the full limit, which for her is 64,500 as a voluntary after-tax contribution into her solo 401k. So now you said she makes 70,000 as W-2 from her S corp. You got to do the calculation. I'm not sure she's going to make it all the way to the full 64,500 because she actually has to have enough money after paying state, federal, self-employment tax to be able to push that back into the plan as a voluntary after-tax contribution. So she'd be basically limited to whatever she has after paying taxes on that.
Awesome. Great question, Steve. And thank you, Eric, for that great answer.
And got a question from Lee. He says, I have a W-2 job, but have a side hustle as a sole proprietor. Can my sole proprietor income be contributed to the after-tax account?
Absolutely, Lee. You'll want to look on your Schedule C, and it's going to be your net earned income. So after your deductions, that number will let you know how much you can contribute as voluntary after-tax contributions. The next question comes from Tracy. How often do you need to fill out? Oh, I think we already did this one. Just kidding. Okay, question from Yvonne. Would you recommend that we open Gemini with you and send our coins from our existing Coinbase Pro, Kraken, so both Roth and pre-tax coins can be in the same exchange at Gemini?
Yeah, I would recommend that. Like Alana said, we're doing our program, the first 60 days, trades are just 0.35%. So there's no, if you hold the coins on Gemini, on the exchange, there's no fees for just holding the coins on there. So yeah, if you want to have, access to the Gemini platform to buy and sell at those 0.35% for the first 60 days. And then after that, it's just 1.35%. So it's still pretty darn low. I think it's actually lower than Coinbase Pro and lower than Kraken as well. So if you go to that link, if you're already a client, go to that link. We actually go over kind of a cost comparison on trades. So a little bit of information for you to consider. But yeah, you can continue to go the DIY route, or you can let us help you, set your accounts up. And as far as getting, monies over from those new accounts, once you have an address at Gemini, you can just make sure they're the same tax classification, right? If they're pre-tax, just send them to your pre-tax. But yeah, you can send them over to that other exchange.
Perfect. And Yvonne, excuse me. You want two accounts. So if you're gonna utilize Roth and pre-tax, make sure you fill out two applications with us. And like what Eric said earlier on, when you're filling out the application, you're putting your trust name in. Do a dash Roth for one of the accounts. So you'll have one designated just for your Roth funds and the other one designated for your pre-tax. So yeah, perfect. Move on over to us. We're happy to get you all set up with Gemini.
Question from David says, what is the maximum contribution from the employer side for the voluntary after-tax contribution for a person over 50 years old? We do not plan to do the profit sharing. We do not plan to do the profit sharing for pre-tax.
So there's, the voluntary after-tax is the voluntary after-tax. It's not an employer contributions, it's employee. So the voluntary after-tax is pretty straightforward. it's 100% of your net earned income. So that's how you'll be able to calculate it. If you don't plan on doing any other contributions, great. You can max out on $58,000, at least as long as you're making $58,000 and you're under 50, and you'll get that bonus catch up if you're over 50. Did I answer his question, Eric?
Yeah. So, I think the biggest thing, it's not, the voluntary after-tax is not an employer contribution. So, and because you're 50 years old or over 50, your maximum plan solo 401k plan contribution is $64,500. So that's your maximum, voluntary after-tax contribution. So, the key piece is just that you made enough money, either by W-2 if you're incorporated, or net business earnings if you're not, to be able to contribute to the voluntary after-tax after paying taxes.
The next question is from Gary. Is the start date for the Roth component the same as the start date of my solo 401k, even though I've not funded it yet? It would help eclipse the 5-year rule for me.
The 5-year rule. So 5-year rule has to do with, I think you're thinking of contributions, Gary. So when you contribute to a Roth 401k, in order to get money out tax-free, it has to be both held in there for 5 years and you have to be 59 and a half. So it's not necessarily based on when you set up the solo 401k with us. It's based on when you actually made those contributions. So your Roth, just to be clear, your Roth component of your solo 401k, that did start when you started your plan with us, or if you had the plan before that, maybe before that. But the contributions has to do with what date you made the contribution. So I think that's if you need further clarity there, and because I'm not sure if that's the 5-year rule you're referring to or something else, but that's what I'm assuming.
Yeah. So it has not started yet for you, Gary, because you have not made the contributions. Even though your solo 401k has been opened and you've had the component, you have not yet made those contributions. Perfect. He liked your answer. We're all good. Thanks, Gary.
Very good. I'm glad. Another question from Eric. He says, can money in regular Roth IRA be moved / converted to Roth 401k?
Yeah, Eric, it's a good question. And unfortunately, a Roth IRA cannot be moved, converted. It cannot go into the Roth 401k, only the other way around. A Roth 401k can go into a Roth IRA, but a Roth IRA cannot go into a Roth 401k. Okay, the next question comes from Brian. Assuming an S-Corp W-2, so to make a $58,000 after-tax contribution, how would I have to pay myself? Would I have to know how much I would pay in federal, state, and FICA taxes? What is the net income net of? What exactly do I have to subtract from my gross income? Healthcare plan deductions? What if the tax withholding would result in a tax refund? I still can't use that portion for a voluntary after-tax contribution.
Definitely work with your CPA, Brian. We're giving you as much as we can here. We can't give you tax advice. But yeah, just suffice to say, it has to be the money that, just think of it like if this wasn't your business and you're a W-2 employee of a company, this is you as the employee of that company taking money that you made after tax and putting it back into the plan. So you just have to have enough to justify making that contribution after tax, right? So like if you're W-2, but yeah, what that W-2 needs to be exactly, you need to definitely work with your CPA to do those calculations. I would definitely double check with them.
Perfect.
Question from Eric says, for the after-tax contribution, it's gross salary minus FICA minus federal and state income tax. Is it taxes on W-2? What if I'm overpaying taxes on W-2 and we'll be getting a refund?
Yes, great question for your CPA. So like always, guys, we can't give out tax advice. That's why we always recommend that you have a CPA that's familiar with all kinds of these questions. If you do not have a good CPA, we have a great CPA resource list in our knowledge base. The next question comes from FB. Just to reiterate, sole proprietor side hustle income can be used to make a voluntary after-tax contribution, provided the sum total between W-2 and side hustle income is less than $58,000, correct?
So, so money contributed to the solo has to be from that side hustle. So like so it has to be contributed from the sponsoring business. So if that sole proprietor business, the side hustle that you have is the sponsoring business, then that's where contributions have to come from. So if it's like, you made money in a W-2 job over here that's not related to your business, that can't be just pushed into the solo 401k. So it has to be from that specific sponsoring business. And just assuming that you made enough after taxes to do that full $58,000 from that sponsoring business, then you could do that as a voluntary after tax.
Yeah. And don't even think about your full-time W-2 job, whatever you're contributing to their plan or whatever you're making in W-2 wages at that job that's not your side hustle. Don't even think about that. Just focus on your side hustle business. You as a sole proprietor, how much are you making in this business? That is going to decide what you can contribute for voluntary after tax. So no need to even calculate anything in your full-time job there.
Yep. Question from Ball. He says, you suggest 3 bank accounts are better for record keeping. Bank accounts, 401k, 401k Roth, 401k VAT.
Yep, that's perfect.
Yeah. However you want to designate it, you could write it all out or you could have it abbreviated, but yeah, all of that works.
Okay, we're going to take one last question from Lee. Since the amount to contribute to voluntary after tax as a sole proprietor is the net on Schedule C, this would require that taxes be prepared prior to the contribution. I generally file an extension. Is it possible to contribute 2021 after tax at the time taxes have been completed in 9/2022?
Yeah, so you can make contributions all the way up till you file your taxes, Lee. So, so if you need to wait until your CPA or they do the calculations for you, then yeah, that's totally fine.
Perfect. Okay. Oh, we'll do one more real fast from Ball. When you do a direct rollover from an IRA, a traditional, to a 401k, do you need to prepare a 1099-R? So Ball, where is this traditional IRA coming from? Wherever it is coming from, they will actually do that 1099-R for you. So if it's coming like from Fidelity or Schwab, they're in charge of doing the 1099-R. You'll get it either in the mail at the end of the year or the beginning of the following year of when you did it. Just look over it. That's all you're required to do. Look over it. Your CPA may want it. You just want to make sure that it says 0 taxes due in the taxable box. So great question. Okay, that was great. We're really enjoying doing this little mini series on contributions. You guys have great questions. We feel like you guys are really here to learn. So we just absolutely love it. Next week, we are going to do the mega backdoor Roth. So thank you everyone for also holding those questions for next week. That's awesome. Eric, you want to send everyone off?
Yeah, it's been a great, afternoon, morning. It's morning for me, but afternoon for some people. Yeah, thanks so much for joining us, guys. We're also doing crypto webinars every Thursday at 6 p.m. Eastern, 3 p.m. Pacific for the next several weeks. Don't know how long we'll do those for, but we'll be doing them continuously here. So join us for that. And then we're also doing, like Alana said, the mega backdoor next week. So also, if you guys have other questions, we have open Q&A on Mondays too. So shoot us your questions. We can include those on the open Q&A. But yeah, it's been fun, and let us know how else we can help you guys. We definitely do want to help you get the most out of your solo 401k with us. So we'd love your feedback. So, but you guys have a great rest of the day, and we'll look forward to seeing you on the next webinar.
Bye, everyone.